One rainy season can influence the price of your vegetables, the strength of the economy, and even the RBI's interest rate decisions. That's why economists have long called the monsoon India's real finance minister. But why does rain still matter so much to a nearly $4 trillion economy? The southwest monsoon is India's economic lifeline. Between June and September, it delivers nearly 70% of the country's annual rainfall and supports an agricultural economy worth nearly $300 billion. Even today, around 45% of India's farmland depends entirely on rainfall. So when the monsoon performs well, farm output rises, rural incomes improve, and food prices remain stable. But when the rains fail or arrive at the wrong time, the effects ripple across the economy. And it's not just about how much it rains, it's also about when and where it rains. A season may appear normal overall, but poor rainfall during sowing or flowering can still damage crops. June marks the beginning of the Kharif season, when farmers sow crops such as rice, pulses, and oilseeds. Rice needs steady rainfall. Too little delays sowing. Too much can flood fields. While states such as Punjab and Haryana are protected by irrigation, many rain-fed crops, including pulses and oilseeds, remain highly vulnerable to rainfall fluctuations. And the impact doesn't end with one harvest. Monsoon rainfall also replenishes reservoirs and groundwater that support winter crops, such as wheat and mustard. A weak monsoon today can therefore affect agricultural output well into the next season. Now, this is where the monsoon begins to affect every household. Poor rainfall reduces the supply of vegetables, pulses, and edible oils. Demand, however, remains largely unchanged. The result is higher food prices. Food accounts for nearly 46% of India's consumer price index, making it one of the biggest drivers of inflation. According to Quantico research, a 10% rainfall deficit could add as much as 1 percentage point to headline inflation, largely through food prices. And when inflation stays elevated, the RBI has less room to cut interest rates. The impact doesn't stop at food prices. When farm incomes fall, rural households spend less. That affects demand for tractors, motorcycles, smartphones, fertilizers, and everyday consumer goods. The numbers tell the story. During the drought years of FY15 and FY16, tractor sales fell by 13% and 10.5% respectively. Even in FY24, when rainfall was only mildly deficient, tractor sales declined by 7.4%. Since rural India accounts for nearly half of the country's consumption expenditure, weaker rural demand eventually affects company earnings and overall economic growth. That's why sectors such as FMCG, automobiles, agrochemicals, banking, and microfinance closely track the progress of the monsoon. And the RBI does too. Between 2014 and 2024, agricultural GDP grew at an average of 3.8% in years of normal rainfall, but only 1.2% in years of deficient rainfall. This year, India is bracing for a weaker monsoon. The IMD has forecast rainfall at around 90% of the long-period average amid emerging El Niño conditions. The government says comfortable rice and wheat stocks should provide some cushion. But economists caution that stocks cannot fully offset shortages in rain-dependent crops such as pulses, oilseeds, and coarse cereals. There is another concern. India imports a large share of its edible oils, and weaker rainfall across Southeast Asia during an El Niño year could also push up global edible oil prices. So, a weak monsoon doesn't stay confined to farms. It can raise food prices, reduce rural incomes, slow consumption, influence inflation, and shape the RBI's policy decisions. That's why every monsoon forecast is watched not just by farmers, but by businesses, investors, policymakers, and ultimately every Indian household. Follow Business Standard for more stories.